Londra'dan herkese merhaba. Londra-İstanbul hattında piyasalara özel bir parantez açıyoruz. Bu bölümde ekonomist Simon Quijano Evans'la birlikteyiz. Hi Simon, welcome to our show.
Good morning.
As we close out 2025, how would you characterize the global macro balance sheet in terms of growth, inflation, central banks, geopolitical shocks, and markets?
Well, that's a lot of questions in one, I must say, and we could talk about this probably for about 5 or 6 hours. But to keep it short, I think there have been so many surprises, whether it's on the geopolitical front about the tariffs going up, tariffs going down, tariffs coming up, economists having to revise their estimates for GDP, for inflation, the outlook, etc. GDP growth actually higher probably than expected in H1 than most people expected. Why? Because companies were building up stocks, trying to sell things at a lower price before the tariffs kick in the US, for example. And the rest of the world doing pretty well because of the weaker dollar, and something probably that the US administration wants. So I think in general, one can say this was a much better than expected year from the financial markets perspective. Equities going skyrocket through the roof. From a growth perspective, and possibly to a certain extent from the inflation perspective, although we still need to see what happens with that in the next 3 months.
So, in this big picture, where do you think Europe sits? Because the implications for Europe is important because Turkey has very deep trade ties, as you can imagine, with European countries. So, I wonder how you see Europe, European countries, and euro-dollar parity.
So, look, on Europe, I think there's too much negativity out there. And what I tend to focus on is what Central Eastern European members of the European Union have done in the last 30 years. I mean, countries like Bulgaria, Romania, Lithuania, Estonia all had GDP per capita levels around 5 to 10% of Austria. Today, those ratios are about 30 to 6%, 60% of Austria's per capita GDP. So there's been this huge convergence story, and I think this is a very strong positive. The second thing is that if you go into individual cities, for example, in France or Germany or Austria or even Spain, you see that things have done pretty well. Infrastructure has been developed over the last couple of decades. So the basis is there. We're all talking about debt to GDP, etc. We need to deal with it. I don't think it's such a big disaster, these high debt to GDP levels from the government side. I think we're going to be able to deal with it. But the other thing, obviously, supporting everyone is the weaker dollar, as I mentioned before. And I think that's good for Turkey from a European perspective, and it's also good for the Turkish lira.
So do you think euro can keep its strength in the coming months? What do you expect in terms of parity?
I think tendentially one could say that the euro remains relatively stronger versus the United States dollar, especially as the Fed is probably going to continue cutting rates. So we talked last time about 3 rate cuts for this year. Obviously, everybody's waiting for the December meeting. And luckily, interestingly, the TCMB meeting, so the Turkish Central Bank meeting, is one day after the Fed meeting in December. So they have the advantage of being able to see what the Fed does. The only issue is that we need the data. We haven't had much data out of the United States in the last 2 months because of the shutdown. But tendentially, I would say continuing over the next 3 months, a slightly weaker dollar.
Mm-hmm. Simon, there is the markets pricing, and on the other hand, there's the reality of the real economy. So, do you think a correction is coming in terms of markets pricing? Because sometimes we are talking about the Fed. What will Fed do in December? Is there an AI bubble or not? Is the global macroeconomy is weak or not? We are sometimes talking about these fears in the markets. But the markets keep going well. So do you think there is a correction looming in the markets, or are we postponing it to 2026?
So the first thing I would say is no one has a clue on that. Yeah? And very clearly, if you look out there for analysis on what net effect AI is going to have on the economy, no one will provide you with a clear analysis, simply because nobody knows. What we know is, according to a KPMG survey of about 1,300 CEOs across the world, 10 to 20% of budgets, of company budgets, are being invested in AI. But a lot of these companies are just following the trend because they need to, but we don't know what effects that's going to have. And a lot of people don't even really know what they're investing into. That's the first point. The second point is that if you look over the last 20 or so years, then you can see that the S&P index, for example, has increased by an average of around, I think, 9-10% per year, whereas the gross domestic product, the nominal gross domestic product for the US has increased by half of that. So what you've seen is that the equity markets have massively increased their AUMs, basically the market capitalization, whereas the nominal GDP, which needs to follow, and that's the underlying, as you said, the real economy needs to keep up with that. So I think from my point of view, there's clearly a bubble. We simply don't know when that bubble will burst because we don't know what the net effects of AI are. But I would very clearly tend to be on the cautious side as far as this is concerned.
So in this big picture, when you look at the markets and the reality of the economies, where do you think Turkey sits in this big picture?
So Turkey, one fortunate thing for Turkey has been the weaker dollar this year. That's very clear. Now, looking at Turkey for the last few decades, the one issue for Turkey, and now in the summer we've seen that the current account surplus has been there because of tourism revenues, etc. Now, to me, Turkey needs to really establish itself as a global macro player. It has the possibilities to do it. Alternative energies possibilities. It has the human capital. If you look around the world, a lot of the chiefs of companies are Turkish people. A lot of head of research in banks are Turkish people, as you know. So there is this huge amount of human capital which Turkey can capitalize on and still needs to do. Yes, and I think that moving forward, Turkey should be able to establish itself there from an industrial point of view, as it has done, from an intellectual point of view, from a services industry point of view, in order to bring that current account deficit down in a sustainable manner. And then you'll start to see other things like inflation, like interest rates, etc., come down.
I would like to ask Turkey's interest rate path, what is realistic for next year as well, but how do you assess the outlook for Turkish monetary policy right now? Are market expectations for more rate cuts in December justified? What do you say?
No, I think they are justified. I think we maybe been a bit surprised on the upside in Q4 as far as inflation is concerned. I think the central bank was definitely. Looking ahead into 2026, I would imagine that we have another 10 percentage points approximately in rate cuts from the central bank, which would leave forward-looking real interest rates on a 12-month horizon at about 9 to 10%, which is really very high, one of the highest, if not the highest in the world. So I think as long as the central bank continues with its prudent policy and is allowed to act independently, things should be okay. And then we continue to see the FX move of the Turkish lira in line with inflation, maybe slightly less.
Mm-hmm. Simon, do you think the current real appreciation of lira is still sustainable?
Well, throughout the summer months, it was sustainable because you had all these inflows of dollars. Yes? So obviously the winter months and the spring months become a bit more difficult. So over the next 3 to 6 months. But I think on a 12-month horizon, a slight real exchange rate appreciation of the Turkish lira should be manageable. But we also need to see these policies that I mentioned before in order to bring the current account deficit down. And that's where the government really needs to play.
So I would like to ask the foreign appetite for Turkey. How do we finish 2025 and what should we expect from 2026? I mean, in terms of how strong the foreign demand for Turkish assets, bonds, euro bonds, equities as we end the year, and what conditions will determine portfolio flows and external financing next year?
I think looking into 2026, given that emerging markets as a whole have performed so well, especially on the local currency side this year, and probably much better than most people would have expected. I think there is going to be some caution from emerging markets investors going into 2026, given the surprises we've seen in 25. I think from that point of view, obviously, local currency assets in Turkey will be looked with a bit more caution, especially given that interest rates have come down now, and we expect interest rates to continue falling. And obviously, the other thing I think we need to not forget, obviously, is geopolitics, given that Turkey stands really in the middle of the region. So I think from that point of view, and I'm an optimist, I think that Turkey could very much benefit from an improvement in the geopolitical perspectives in the region. So I think on balance, it's not going to be a stellar year, but it should be a relatively calm year where Turkish assets can continue improving their performance.
Simon Quijano Evans, thanks for joining our program.
Thank you.